It was a roller coaster ride on Wall Street today, a rate shock hitting stocks only to turn around late in the day. Gold surging to yet another 6-year high, but you might want to break out the Dramamine because our next guest says the wild moves in the market are far from over. Let's go off the charts with Newton Advisors President Mark Newman. Mark, what are you looking at?
Thanks, Melissa. Yeah, volatility is back in a very big way if today's roller coaster taught us anything. So let's take a look at three key markets: Treasuries, S&P, and gold. You see yields. All of a sudden, stocks have started to act very much in tandem with yields, moving in the same direction. This didn't happen last year. You saw the break of this longer-term uptrend in yields. This happened last December. That was right when actually stocks were bottoming. So yields have been going down literally this whole time when stocks have actually rallied up until May. That changed. It was really the break of 194 last week. That really precipitated the entire sell-off in risk assets. So we saw a quick move down, almost 40 basis points in yields within 5 trading days. S&P followed suit. We moved down. We see now RSI is down at a 20 on a weekly basis. That's the lowest level we've seen in more than a decade. Even back in 2008, we saw rates go from about 5% to 2%. RSI did not get to 20. So we are very oversold. Technically, 1.55 to 1.57, I think, is a near-term floor. But any bounce really should be used as a chance to buy treasuries. My thinking is we're going to get back to right near prior lows from 2016 and 2012. We were really right between 132 and 137. It seems a long way off. We're heading towards the seasonally bearish months of August, of course, latter part of August, September, which traditionally are bullish for treasuries. It's right to be long treasuries. So right now, that's the trend for treasuries. Any sort of bounce would be used as a chance to really buy treasuries. What happened in S&P? We got down under 29.54 last Thursday when the 10-year broke 194 to the downside. This also coincided with prior highs back in late April, May. The common saying, former resistance becomes support. When this is broken, two different areas of prior resistance to support broken, that gave way to a big period of acceleration down lower. So where are we now? Near term, we're starting to get oversold. We're starting to see VIX backwardation, put to call equity put to call reach the highest level of the year. My thinking is we are close to a near-term low, but I can't rule out a move down to really test the lows that we're seeing back in June. That's 27.32. That's going to be a big level. Under that would give way to a move down to test last December's lows. Right now, I think it's premature. Fear is starting to rally and really raise. We're seeing fear up very quickly based on the pullback we've seen, of course, for a lot of the right reasons. We see, policy uncertainty, lack of a trade deal. All those things are weighing on investors' minds. So as S&P sells off, fear is rising much more quickly than what we expected, with S&P down only 5% from the highs. Here's the monthly chart. This is what's interesting. Look at what's happened with momentum since last January. We reached the highest period in RSI we've seen in over a decade. This is important because on subsequent retests, we've moved higher and higher. Momentum has gone lower and lower and lower. For me, that is an intermediate-term concern. We saw that back in 2007. We also saw it back in 1998 to 2000. Both those things warn it's not a bear market potentially, but we are seeing a slowing down of momentum, and that could be problematic heading into next year. For now, you got to watch 27.32. A break of that takes us down to really last December's lows. That really is the larger line in the sand. We cannot break last December's lows without thinking we are going into a bear market very quickly. Finally, let's take a look at gold. What's happened with rates pulling back? We see the dollar gradually starting to roll over a little bit. If the administration uses any sort of attack on the Chinese by trying to take down the dollar, of course, that'll be even more bullish for precious metals. We saw gold get above this key level, 1365. That was a 6-year breakout for gold. Near term, we've gotten above 1,500 in the last couple of days. Momentum has gotten very overbought, really at 83 on a weekly basis. If you're a trader, you want to sell into gold initially between 1520 and 1580. For investors, though, you really want to stay long over the next 12 to 24 months, I think, and really any pullback is a chance to buy the precious metals. We should be entering a time when commodities finally start to work. We're seeing a little bit of evidence that finally with gold and with silver, one of the better places to be in the near term.
What do you see for the dollar, Mark? And should we assume that the typical correlations that we see between the dollar and gold or dollar and rates hold?
You know, a lot of this, Melissa, is going to have to do, I think, with Brexit, obviously, with a lot of part of the dollar, at least the DXY is versus not only the euro, but against pound sterling. So, near term, you could see the dollar sort of churning like we've seen. But in general, dollar should be beginning an 8-year pattern to the downside, an 8-year cycle. We've seen these historically over time, which means, in my view, the dollar should be heading lower over the next few years and not higher. So that really weighs in and justifies my thinking that commodities should be outperformers over the next year or two. it's right to own hard assets and really potentially diversify out of stocks starting next year. But this volatility, I think, is a straw that's breaking the camel's back, and it's definitely a wake-up call in terms of volatility.
Mark, thank you. Mark Newton of Newton Advisors. What does the world look like if rates go back to 1.35-ish? Does the
outside of the U.S., you mean?
No, here in the United States on the 10-year yield. I mean, does the old sort of reaction that things must be bad and the Fed will step in as a backstop, does that no longer work? Or is it just hell in a handbasket at that point?
Well, Mark talked about the correlation between stocks and bonds. And to me, the minute that broke down, the positive correlation wasn't good. But the minute that broke down, that told you 136 is terrible for equities, is my view.
Pete?
Well, I would just answer something about what Mark was just talking about in terms of SLV, GDX, GLD.
You love
absolutely. That. Since June 1st, it's been absolutely a monster. And today, they were buying the SLV, which we'd seen a little bit of that, and it's not moved nearly as much as gold. But keep an eye on silver. I think it's ready to explode to the upside.